All right, so the Rockefellers are a family that have continuously created generational wealth. Obviously, they're a family that we hear about all the time, and they're a family that will forever have legacy, a family that will forever have generational wealth. And what exactly did they use as a tool to create this generational wealth? Well, there's two functions to this, and it's called life insurance. Second is going to be a trust. And a trust is essentially, how would I want the money to be spent if I were to be alive, even though I am dead? So it's essentially saying, hey, I want this to function XYZ, even though I'm 6 feet under the ground. So like I was saying, the two things that we're going to need when talking about this concept is going to be life insurance, and it's going to be the trust. So this box here, we're going to say is the trust. Okay, it's just essentially documents that is going to be controlled by a trustee that essentially says, when I die and I pass away, I still want XYZ to happen, even though I'm not here. And so what we're going to do is we're going to take life insurance, and what we're going to do is we're going to put policies on somebody. Okay, so we're just going to say that this policy is going to be on a father. Okay, so first policy is going to be on the father. They are going to be the insured. So essentially, when they die, they pass away, their funds are going to get paid to X, Y, and Z. And so the father, being the insured, has to choose who the beneficiary is going to be. Now, they can make the beneficiary their spouse, they can make it their kids, they can make it whoever they want. But let's say that they want their kids to benefit from this life insurance policy. What happens if you have a life insurance policy that pays out $5 million and you're just going to write a check essentially to your kid, essentially say, hey, here's $5 million. Now, that could or could not be a bad thing depending on the child, how educated they are, who they are, their knowledge, how mature they are. But what if they're a 19-year-old kid and you just gave them $5 million? How many 19-year-olds in this world do you think are going to be able to take those dollars and effectively grow that for them, their family, and generations going forward? Not very many. I would argue a very small amount, which is why there's statistics around college or professional athletes that get all this money and they go broke and they go bankrupt because they're not shared how to essentially use this money to provide more wealth, how their dollars work for them, and why lottery winners, they essentially will go broke or bankrupt within a couple of years as well, because there's just not a ton of people that are educated. And if they are educated, there's going to be a lot of obstacles in this world, especially when they're younger, to try to figure out, well, what is it that I do with this money? So if you are older, you've been around for 60 to 80 years, you have the education on how this should be done, well, you will put that in the trust. You'll say, this is what I want to happen at every single year, every single age. Here's what you can and cannot do with it. So what we're going to do is going to make the beneficiary, okay, the benefish, okay, the trust. So now, when this person dies, the father, okay, the beneficiary is going to be the trust. So now we have, they say the dad died, father died, okay? And now the dollars are in the trust, it's essentially in cash. And you have written that you want this money to essentially be used in a way to where you're going to start another policy. And so who do you want the policy to be started on? Well, on your son, daughter, so on and so forth. All of your kids essentially is who we're going to put them on. Okay. So now let's just say you had 4 kids. You now have 1, 2, 3, 4 policies, life insurance, that are out there in your ecosystem as a Rockefeller, or for me, a Ruth Rand, or Caleb as a Williams, that are out there that is then put into a generational standpoint. And why is that? Because, well, they're all going to die at some point in time. If they die, they pass away, well, where's the death benefit going to go to? Well, you said it, not me. The death benefit is going to go into the trust. Why? Because we said that the beneficiary, we as in the father who set it up, wants the beneficiary to essentially be the trust. And then when they die, these 4 die, they're going to put it on their kids. And each one of these kids each one of these 4 had 4 themselves. Now there's 16 kids that are out there, and those all 16 are going to have their life insurance on them. And that life insurance will then go back into the trust when they die, and it'll just have a trickle effect over and over and over again. Now, there's also rules and regulations in regards to what the trust is saying of how the dollars can be used. The trust will say, hey, you can't use these dollars for anything but business, for real estate, for impact, to be able to create more wealth. How powerful is that when we have 4, 16, 32, 100 people within our generation with our last name that are all going out there and creating impact? And when you create impact and you add value to the world, you leverage your value, what ends up happening? Money follows value. So what you've done is you've created an entire army of people who are using life insurance, borrowing against it, to go ahead and build more wealth in real estate, to build more wealth in charities, to build more wealth in all of these different factors where you can give, which then comes full circle back to you, which then comes full circle back to the trust. And when you die and pass away, the death benefits will also pay off the policy loan and start more policies and so on and so forth. So this is a way of a circle of how money can never, ever, ever run out, because you always have ways that generational wealth is being built through policy loans to create more value through real estate, through business, through opportunities. And then when the person dies and passes away, well, that death benefit will pay off the loan and start more policies. It's called the waterfall method. And it's just absolutely incredible how you can really start with you being the person that changed generations and generations of wealth, because it started with you. Like I said, you may not have wealth today, but it sure as can start with you and your future family. So I hope this helped. Please put below in the comments if you have any other questions on how this works. And I'm more than happy to continue to educate on anything that you want to know about. So please like, share, subscribe, and tell us more.